Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Cedric de Fontclair, manager of the Jupiter European Special Situations Fund, to give his 3 stock picks. Hi Cedric.
Hello.
What's the first company today?
The first company I would like to mention is Pandora, which is the affordable jewelry retailer. I mean, you probably know the brand here in the UK. You can see it on buses at the time of Christmas time or Mother's Day, etc. So they've got a very nice growth in the UK, but generally it's the Western world play. So they've got a very strong footprint in the US and growing very fast in Germany. Now, where's the upside? The upside is that they've got nearly no business in Asia, and they're just expanding successfully in Asia. I know it's a tough environment, but they're starting from a very, very low base, and actually they've got quite a good success in a lot of Asian countries at the moment.
We have seen some retailers expand into emerging markets, such as Tesco. I know food retail is slightly different,
yes.
and they've had their fingers burned. I mean, what's going to be different about the Pandora story?
I think it's the pace about how quickly you open shops. If you've got even a very successful brand like LVMH, Louis Vuitton is closing shops now in China. So it's all about extravagance and aspiration about how much growth there will be in these countries, which pushed retailers to open a lot of shops. In the case of Pandora, they know the situation is tough and they go slowly. The attractiveness about the business, it is extremely cash-generative business. The silver price has been coming down. They don't decrease their prices at the retail space because consumers have got no idea that these items will cost less to manufacture. So the gross margin and the margin is very, very high. The cash conversion is extremely high as well. At the same time, this company doesn't need the cash they're producing, and therefore they're returning that in the form of dividend, which is about 2%, and share buyback that they just announced, which is 5%. So you're getting already a 7% total return without thinking about the earnings growth.
And what's the second stock today?
Now, that's a controversial one. It's Tenaris, which is doing a seamless pipe for the oil and gas industry.
Which I think most people would think, not today, not now, not at the moment.
Clearly, I've been away for that sector for a number of years, and that's the first time we're investing in that company in recent years. 1% position, but we think that's already the current valuation is discounting a very, very unfair scenario. What's happening is that the company obviously today has got half of the profit they've been able to achieve in the past. Function about people drilling less, basically less production, less exploration. But when you look at the balance sheet of that business, this is a company which is sitting on $1.7 billion cash on their balance sheet. Now, they're investing in their business not to increase capacity, but to modernize and to get a cost leadership advantage. And when the oil price will bounce, and I've got no idea when it's going to happen, but in the meantime, I get a 4% dividend yield, that company is very much exposed to that kind of theme. So that will be one of the survivors out of the crisis.
Basically, they can afford to sit out the oil price.
Clearly they can afford. And again, it is a cyclical industry. We are at the very low point of the cycle at the moment. Current share price is discounting that returns will stay at this very depressed level for all time, which is very unfair given the cyclical nature of that business.
And what's the third stock?
The third one is a French company, if I may. It's called Vinci. It's a construction company. It's a European play. And a French play to some extent. So they're operating motorways, particularly in France. Now, the French economy is slightly improving, obviously, from a very depressed levels, which means that consumers get a bit more money, particularly with the oil price going down, so they can afford driving more their car. That's one big driver. The second driver with that business is the construction-related activity. And again, we had several evidence for a number of companies recently that the construction industry is improving in France at the moment. So they are geared to that. And at the same time, you've got the cash flow generation coming from the concession business, and it's a 7-8% dividend, cash flow yield type of stocks, and they're returning nice money also to shareholders. So it's not a high growth company, but I think it's a visible growth that so many people are overpaying at the moment when you think about Nestle and others. I don't buy those stocks. I find them too expensive. And in case of Vinci, I think you get the same kind of visible growth, but at a lower price.
Cedric, thank you very much.
My pleasure.
This is Emma Wall for Morningstar. Thank you for watching.